Welcome to the Financial Estate Literacy. It's your money series. This week is week 2. We're going to talk about financial planning 1. I am going to share my screen again. So as we go through this, what I want to point out to you is, that guy went away.
Gerald, go ahead and remove yourself from the screen. And if you can.
He's gone.
Okay, thank you.
This time we've gone through and established a workbook that goes along with the series. It's available, and I'll show you in a few minutes when we go live with it. Being able to go through and look at what all's going on week by week and some areas for you to be able to give some thought to it, goals and objectives, assumptions, where are you today, what's going on in your life and what's happening. And it'll allow you then, there's the cover for it, if you will, in terms of where this stands. I need to click on something down here. Pardon me for a moment. There you go. Okay. So this goes through and shows what's happening during week by week, so you can see that, but gives you some ideas, and you can download this, and I will show you in just a moment what that is and where it's available. So let me go live, Pete, to this. So this is live on the website, going through and showing you, and if I get this guy out of my way, I can see better. Okay, so
go to the last week if you can.
That's where I was heading.
All right.
In my case, I can go previous. So here is, we say the videos are online. This is last week's video. It's already here and available to you. And you can download all of that material, the articles and all of the other things that we went through for last week. And oh, I'm sorry. Now I know where it is. And in here each week, so I'm going to cut. Do you want to say something about last week?
No, just that the entire video is there.
Yes.
The workbook is there, and also the articles that we didn't go through last week are there.
Mm-hmm. Yep. And so I want to come to next week, which is this week's. And so it's your money series, and one of the things that is here is the workbook that we're talking about is available, and each week the presenters, so in terms of the presentation for today that Laurie's going to do, the material is here, her Ask First form is here, and various articles are here and available to you. So all of that is available to you through the website, and is there along the way. Okay. So let me do one other thing here. I'm going to come back to.
And Gerald, you're looks like you're still sharing the screen. At least you're, there it is. It's gone. Okay. Are we ready to begin?
Here, not quite. One more thing. So, whoops, our weeks. So week over week, what we will do is, last week was the overview. This is financial planning 1. Those of you who have attended these before normally did planning 1, planning 2. We felt it was better to move planning 2 to the end, sort of let's bring all these pieces together. Next week, we'll do medical care. The week after that, investment world, which we sort of pulled some pieces together, because the investment world is a very strange world. Then having equity and fixed income investing. And then we will finish up with financial planning at the end, the second financial planning. So I'm going to stop sharing. As we do, I am going to disappear here in a moment when Pete introduces our presenter. I will keep an eye on the question and answers, ask them along the way as appropriate. If not, we'll save them and ask them at the end. So Pete, you're on.
All right. Well, welcome everybody to Financial and Estate Literacy. And we're going to get onto our program with Laurie. Laurie, why don't your screen come up? Hello.
Good morning.
Good morning. Let's go right into your Ask First form so we can introduce you. Aha. So you have a master's or other advanced degree. What is that in, Laurie?
My master's degree was in healthcare administration back in 1990.
1990. Okay. And then you went into the financial services industry. What got you to make that change in your career?
I was running a healthcare related nonprofit organization, and my staff would not enroll in a 403B retirement plan with a 6% match. And I had to figure out why. I realized I was much more interested in my staff's financial health than really doing a a long-term career in nonprofit management.
So one of the first lessons is, as a grandparent, get those grandkids and your family members to participate in their 401k plans. It's the money on the table that you have to save in order to retire well. Let's 8 years experience as a CFP. So you've been 8 years as a financial planning advisor.
Yes.
And we'll go through a little bit of what that means in a little bit, but let's scroll down. And you are a fiduciary. You put your client's interest first, which means basically you don't get paid from any other source except from the client, right? Okay. How do you charge your clients? Talk a little bit about that.
I charge my clients either hourly or on an annual basis, depending on the level of involvement that they need from me in their planning. So
what is your hourly rate?
It's hourly, $300.
And do you work with assets under management at all?
I do. I manage assets, but only if clients want me to manage assets. I don't require it.
And what is that charge?
0.5% annually.
Okay, 50 basis points or 0.5%. Do you charge then on a quarterly basis?
Yes, it's billed quarterly.
Okay, and payment will be made, of course, by the client. You don't get paid from any other source.
No.
Okay, what is your custodian that handles the trades? Schwab. Okay. And you don't sell annuities, mutual funds, or any other financial products. And then you certify that the above is true and correct. Now, those are the basics. It doesn't really tell us much about your personal life or your career, but let me tell you, Laurie is a wonderful person, not only nice, very philanthropic. She's given back to the community and also to the financial planning organization. And today, her focus is going to be on the putting together the initial stages of a financial plan. So Laurie, let's go right to your outline. So whether you're doing this through a financial advisor or you're doing it yourself, you need to go through these steps that we're now going to talk about. So I'm going to give it to you, Laurie, and let's get started.
Thank you so much, Pete. It's a pleasure to be here with all of you. As a certified financial planner, it's my job to make sure that my clients have a healthy financial future and make sure they can reach their goals. Even if reaching your goals means your regular spending from now until the end of your plan. The end of your plan is basically the end of your lifetime. And so we want you to have good longevity. We want you to be able to get there healthfully without worry, without stress, because we know that financial stress isn't good for us. So we want to make sure that we're all prepared in our retirement years and that we're prepared by the time we retire to make it to the end of our plan. So that's pretty much the work that I do. And so today I'm going to follow along with the workbook that Pete's group created so that you know the areas where you can focus and you have a guideline there with you. So financial planning, I'm just going to give you a general overview, is looking at your financial picture and advising you on how to achieve your short and long-term goals. How do we do that? Okay, so it's about what you own. What assets have you already collected to serve your needs? What do you owe? What are your liabilities? And what are your sources of income? So if you have sources of income in retirement or before retirement, that's really great. Without sources of income, it makes it a little bit more difficult. So because then you're just relying on assets. So it's assets, liabilities, and sources of income. And then one of the biggest determinants is what are your expenses? And one of the phrases I love to use with my clients is, what does it cost to be you? It's very personal, right? Everybody's different. And Pete and I could share stories with you from now until dinner time, talking about people who spend too much relative to their assets. We're not going to do that today, but it's true. Most people have no idea that on whether they are prepared to make it to the end of the plan based on their current spending or not. And I'll just say that it changes when you stop working oftentimes, because people are used to spending what they earned, maybe all of it. And then when they're not earning that much anymore, spending has to be curtailed. And many people are not prepared for that. So we have to think about that. And the more you think about that before you're retired, the better off I think you are. But people come to me sometimes 3 weeks before retirement. Sometimes people come to me 2 years after retirement. And I always love it when people start thinking about this a little bit ahead.
By the way, I don't think, a broker, when they go to a financial advisor, they go, what should I invest my money in? And that's not what your first question is it?
No, in fact, the way you invest has far less impact on your plan than how you spend.
That's
I think it's one of the most important concerns for your future.
And there's also the opposite, that people get so stressed out as to what they can spend that they die and lose the pleasure of the monies that they have saved, either by giving it away to family or treating themselves to a trip, or
it's like that, where people really do have plenty of money and should be enjoying it, either using it themselves, sharing it with family, or finding the charitable intent that you've always wanted to have. All those ideas are great ideas if you have enough assets to cover your lifestyle.
What's the number one reason for divorce?
Financial stress.
Yes. Yeah, it's money. So who do you talk to when it comes to figuring out, what do I spend my money on? If you can't talk about it with your spouse, do you go to your psychotherapist, or do you feel like a psychotherapist?
I say I do therapy about 80% of the time and financial planning about 20% of the time.
Yeah, because you have to do the basics first. So let's talk a little bit about that.
So knowing what you have, knowing the assets you have is your job, right? You know best what you have. So the types of assets matter. The kinds of assets that a lot of people like to collect are called depreciating assets. I have a picture of a car here, but these are things that we collect for ourselves that decrease in value over time. Examples are cars, electronics, televisions, things like that, that we might spend a fair amount of money on, especially replacing them every few years. And they really don't hold their value. They might be things we need. They might be things we don't really need, but there are other assets that really people think of as investments that generally increase in value over time, especially over a long time frame. They're called appreciating assets or wealth creating assets. So investments, stocks, bonds, real estate, savings accounts, and your home, right? People often will invest in a home, and over the long term, real estate has turned out to be a positive investment. It increases your net worth generally over time. So it's important when you're spending to understand which kind of an asset you're collecting.
One of the things that I see a lot of times is that just looking at a car, should I lease or should I purchase a car? And the thing of it is that there's no one right answer. It depends on so many factors as to, do you have your own business? How many miles do you do? What's your cash flow? It's very complicated analysis just on that. And what I find is so few people go to their CPA or their financial advisor to discuss it. They feel like they innately just know what the right decision is for them. And
they innately often know the wrong decision.
Yes.
Yeah. It's unfortunate in that we don't really get any training around this decision, and we probably start doing this before we turn 20 years old. Like, it's possible the first car we purchased, we were really young and we didn't know any better. We were guided by our parents.
Yes.
So
But I wanted to get at the thing is that you have to run the numbers. You know, you can't just innately just know, you have to know how to run the numbers. And most people do not.
no.
And so, and in order to create the numbers, can you imagine a medical doctor who gives you a prescription drug without giving you a blood pressure test or what your heart rate is or etc. And this is what the world is in finance. They give you a recommendation on an investment, and they haven't even tested anything about you to see where you are. So let's go to the next slide.
I think one more point is that oftentimes we rely on the car dealership for this transaction, just like we rely on realtors for home purchases. And those people generally don't have our best interests at heart at the time.
No. I've rarely met a car dealer who's worried about my cash flow, except for making that payment.
Keeping track of your assets and having a record of your assets is something you really should have. This is very personal to you, and this is what you own, and you should have a good list, and you should update this list occasionally. So here's a good recipe for the list. Cash, investments, sometimes there are charitable assets, but real estate, vehicles, other assets, things in your home, and then a total of what you own. So for each asset, and Pete has this in his workbook, you should know the current value, what you originally paid for it, and how it's titled. It's very surprising to me how many people in married relationships don't have everything titled together. It's not even separate property. It wasn't inherited and remained separate property. It was purchased maybe before marriage, maybe during marriage, and not titled correctly. And maybe even after a 30-year marriage, never fixed. So we have to be aware of how things are titled. And so I gave you an example.
What is the definition of cost basis, and why is that important, Laurie?
What the cost basis is important because it's what you originally paid for a property or an investment. So in the case of a home, for example, maybe you paid $200,000 for your home, and then you put in some improvements. You added a bathroom, you added a bedroom. Improvements matter. The improvements over time add to what you originally invested. It's more investing in the property. So it increases your basis. And then if your basis is $300,000 and it's now worth $600,000, your gain is $300,000, right? If you were to sell it for $6,000 and your basis is $3,000, your gain is $3,000. If you don't count your improvements or you never made improvements, in this example, your basis is $200,000, you sell it for $600,000, your gain is $400,000. So keeping track of basis, what you originally paid, and then keeping track of any relevant improvements. And every CPA works differently on this issue. Generally, it's improvements, things that made a difference in the home, not just maintenance. But talk to your tax preparer about this and keeping track of that and having good records. And the difference between the revised basis and what you sell it for is a taxable gain. Now, there's an exclusion on real estate for your personal residence of $250,000 of gain per person every 2 years. So per person. So if you're married, your exclusion is $500,000. It's important, however, to remember that you have this gain on personal residence, exclusion from gain on personal residence, but knowing the numbers is the most important part. So the fair market value of what you might be able to sell it for and what you originally invested plus any improvements.
One of the things we don't discuss much in the series is a reverse mortgage on a home, but it's essentially what the mortgage companies promise is increased cash flow so that you can, spend more money. In a typical analysis, when somebody comes to you and says, hey, first of all, I bet you it's not that common, but if they do come to you and say, I want to do a reverse mortgage, what kind of analysis do you go through to get to a point where you can say, here are the pluses and here are the negatives?
Typically, I use a reverse mortgage as a last resort. So I make sure that their assets, they can't do it on their own. If they can't do it on their own with their own assets, their own investments, and have enough liquidity to meet their
spending needs,
then I look at a reverse, but only as a last resort. And also they have to be aware of the fact that there's a debt. They have to stay in the house for their entire lifetime, right? You can't move out. You can't move into a nursing home. You can't leave the house or the mortgage is called. So you have to be able to stay in your house. And also the interest rate that they apply on that mortgage, you are charged that amount from the time you take out that loan. So getting it in payments over the years is different than a lump sum, but you have to be ready for the fact that much of that house won't stay in your estate at the end of your plan. That the house will be sold after your death, and then the assets generated from that house sale will pay down that debt, and the remainder, if there is remainder, goes to your beneficiaries.
Again, it's the analysis that's important, the number crunching.
And I use it as the last resort.
Yeah. Let's go to the next slide.
So we're going to talk a little bit about the types of liabilities. So on the left here, we have wealth creating debt, also known as good debt. So some people call this good debt versus bad debt. Loans used to buy possessions. So home loans increase your wealth over time. They allow you to have that home. Home loans, student loans, because you get a better education, because then you probably enter a career that pays more. Business loans help you sustain your business, and any other real estate assets that you might collect over time with debt. All are good reasons to have debt. Now, other debt, known as bad debt, are loans for purchases that decrease in value over time. Now, cars obviously decrease in value over time, but one of the biggest examples I see of this is vacations. Vacations and other general spending for stuff that you don't even remember because you're paying it off for so long that you don't even remember what you spent it on, right? That you could put $5,000 a year on your credit card for vacations because you can't afford the vacation out of your regular cash flow. And then you're paying down that credit card over a very long period of time with a very high interest rate. And so it's costing you way more than $5,000. And you're continually making credit card payments that you really shouldn't be making because you haven't properly saved, for example, a vacation fund where you actually save during the year and then actually have the cash available instead of using credit. So sometimes we have to fund a car loan, right? But it's that other excessive stuff on credit cards that it's fine to use your credit card if you're able to pay for it at the end of the month when the bill comes.
How about if my son comes to me and he wants to borrow $100,000? Is that a bad debt or a good bet? Good debt.
It depends on the son, right? What is the likelihood that you get paid back? And so I often run those plans when people say to me, can I do this? I run it as if it's a gift, because just in case you can't get paid back, are you able to tolerate it as a gift? If you're not able to tolerate it as a gift, I would recommend no.
Yeah.
Because otherwise you have a relationship problem. If your offspring said, oh, I'm definitely going to pay you back, and then they don't, and you can't afford that, then you have a problem in that relationship. And I don't want that for anybody. So I make sure that they can tolerate it as a gift. I also document the loan. I might record the loan. You have to have, if you do it right, you record the loan with the family rate that the IRS allows you to do. There's protocols around having a real loan, and a real loan is a good idea because it's taken more seriously.
Yeah, and there's also the whole issue of fairness within the family,
Mhm.
because siblings kind of talk to one another. And so if you do something for one, the other one is going to go, why did you do that, mom or dad? And so lots of issues involved. And not only that, some children kind of abuse their parents into loaning them money or whatever. And I've heard situations where you're not going to see the grandkids unless you loan me money. So get people don't understand the value of your services in those situations, because you can step in and help mediate the family issues, or even before they become a problem. So
Yeah, and encourage the very adult children, oftentimes they're 60 years old, to take care of themselves.
yeah, and that's the motto. And the fee-only advisor is there to take care of you and first, and will assist you in helping others, but not beyond. It's that security of knowing that you're making a good decision because you've run the numbers. Let's go to the next slide.
So keeping track of your liabilities is way smarter than just having some general feeling about them. So I encourage you, whether you do this on paper or you do this on a spreadsheet on your computer, one way or another, keep track of everything you owe. The list on the left is a common list: credit card balances, short-term loans, like a home equity line of credit. Even your rent is a liability for the duration of your lease. Any mortgage debt, any car loans, student loans, Parent Plus loans, any other debts you might owe other people. So you should know the current amount. You should know the interest rate. And you should also know when you will be finished paying down that debt. So lots of payments that we make in our lives don't last forever. And the sooner the better, right? The sooner we're done paying for those liabilities, the better off we are, because then more of our cash flow belongs to us. And it's really fun in a retirement plan to say, well, the mortgage is going to end in 2028. Like, you're not going to have that mortgage forever. Or you're paying for medical insurance only until you retire, and then your medical care will be on Medicare. It's a little bit cheaper than your private insurance. Like, all sorts of obligations that we have a lifetime. And so it's important to think about how long will that last for each individual liability.
And sometimes psychologically, you just feel better when your debts are totally paid off. You know, it's and
even one at a time feels good.
Yes, you know, so and for some people that's really important. For others, it isn't. What I hear a lot of times is that, oh, you can deduct this liability or this interest. How much does that weigh into making a decision?
You still have to have the cash flows to support it, right? So sure, your mortgage interest is probably deductible, or some of it is probably deductible. You can use it as an expense on rental property. But some of the other costs, like credit card balances, there's no advantage, right? And so you have to have the cash flows to support those payments. It's not just taxes first. You have to be able to make those payments. B, some of the liabilities don't have tax advantages. So sure, if you could afford it, number one. B, are there tax advantages? And if there isn't, then those should be tapered off as soon as possible.
Yeah. The only good thing about debt is that it dies with you as well. So except for debt that's on a house, but all other debt, credit cards, if you owe more at your death than you have in assets, no one else is liable for those debts.
So just as a note, incidentally, Don's going to speak up here. With the changes in the tax law and the increase in standardized deduction, it really makes a lot of these interest payments unimportant from a tax standpoint, or not useful, because standard deduction, you don't also take your interest, it's in the standard deduction. So that even changes the numbers from that standpoint.
Yes.
And low
Don,
interest rates
Don
have-
just put on a CPA hat, so
Right, with low interest rates, your mortgage debt has been a lot smaller. And because of that increase in the standard deduction, you may not get over that bottom line of that standard deduction.
do you have to keep track of, your coffee? And by the way, I think everybody has a little bit of money hidden somewhere from their spouse or,
Slush fund?
yeah. Do you have to keep track of the smaller amounts, or is just basically a global kind of more of an issue?
I don't know if I have that slide in this deck, but I have a great slide of, do you want to fund your retirement or go to Starbucks, right? Like, Starbucks at $5 a day of only one trip a day is one thing, but if there's 2 trips a day and it could be $8 or $10 a day, it really adds up.
Yeah. Let's go to the next slide.
Okay, so here's your wealth statement, also known as a net worth statement. And basically what it is, it's a list of everything we've talked about so far. So the top section here is the list of your assets and then a total of your assets. It's a list of the amounts you owe, your liabilities, and then you take your assets minus your liabilities, and that's your net worth.
When I was at Long Beach State University, and I would sit down with some of the professors, and one of the first things that we would talk about, because they wanted to talk about, is this a good investment or not? I said, well, let's first look at your net worth. No, probably 90% of them could not put a net worth statement together. They forgot issues like their insurance policy or their 401k plan or their PERS retirement. So where can somebody go to for help? Because it's so important to put a net worth statement together.
Well, we're teaching you today with your workbook and with spending the time to say, what do I owe anyone? What are my liabilities? What do I own? Right? All the statements of every account you've ever had. So you have to think back of all the savings accounts you've had over the years, if they're still open, right? Retirement plans can often be like sprinkled over the years. I have 10,000 here, I have 15,000 here, I have 50,000 here, like all these retirement accounts from every job over time, unless you've rolled them over into current plans, they might be in bits around, and only you know best what those are. And so it's time to sit down and collect all that data and get it on a list.
You should know your net worth statement, what your net worth is, just like your birth date, like your social security number. You just need to know this number. When my dad died, my mother had no clue as to her net worth. They never shared, he just handled it. And so all of a sudden, she is in a situation where she had to discover all this information. And so it's one of those things that you should have written down somewhere. You should see it from year to year, because the bottom line is, as you progress, some assets go up, some assets go down. So unless you have a net worth statement, you can't really tell where you are.
Right. And it's nice during that accumulation phase of the working years to see your net worth go up. It's not surprising during retirement to see it level off or even see it decrease a little bit, because we're spending.
Or possibly having it increase, and you're going, maybe I should be spending a little bit more. Maybe I should be giving it away a little bit more.
The thing about this is you can't judge just from looking at this, right? Us financial planners use all sorts of other ideas in our plans. Like, when do you want to replace a car? How much do you want to travel? How much do you want to give? What's your charitable intent? Let's put some inflation in your spending so that we inflate expenses over time. So there's a lot more analysis, but
it's blood pressure
you can do for yourselves. And this is something that your family, if you have family, deserves to have, just in case you lose the ability to care for yourself. Like, this is a good document to give to your family, maybe with some backup, to say, this is my stuff. And this is a nice summary of my stuff.
One piece of the puzzle.
So, goals. This is really important to know what you would like to accomplish. So here's a fun little exercise. Which of the following are true regarding goal setting? Most goals fail by the middle of January, called New Year's resolutions.
Really?
Writing down a goal is a powerful motivator. Most of us do not have goals. And I bet if we asked our group today if they did, they might say no. Specific goals, which can be measured and have a time frame, work the best. So all of these are true. Now, the goal may be just my general spending. I just want to be able to spend what I spend, or I want to travel every year for $10,000 until I'm 80. And then I want to dial it down to maybe 5,000 a year for local travel in my 80s. Or I'd like to move into an assisted living facility at $8,000 a month. Or I'd like to replace a car every 7 years. Or I'd like to give $100,000 to my children when I'm gone, right? Those are all goals.
But they need to be written down.
They need to be written down. And I'll show you, these are the aspects of the goal that you should know, right? A specific goal. So not just, I want to live my lifestyle. Like, no planner is going to be able to help you, or even help yourself if you go, I just want to live my lifestyle. Well, tell me about your lifestyle, right? What does it cost to be you? Like, there's some data there that we need to know about. So be more specific and be able to measure that goal. Make sure the goal is attainable. So I get goals all the time that are not attainable. So that's where you can work with a planner to figure out if your goal is attainable, but you should have some idea that it's attainable. For example, if you're 75 years old, and I'm just giving you this example, if you're 75 years old and your net worth is $500,000, and you say, I want to give away $2 million, you should have some idea that that's not attainable, right? Let me give you a more interesting example. A couple that is in their mid-60s, the husband makes $300,000 a year. They spend it all. They have $700,000 saved for retirement in their mid-60s. And they want me to help them with retirement planning without changing their spending. They spend $25,000 a month, $300,000 a year, and they have $700,000 saved. Is it attainable?
No.
Right? Not really. It doesn't take like a CFP to figure that out, or a CPA, but they actually thought it was. So make sure it makes some sense to you. Even if you have to say, year one, I spend 300, year two, I spend 300. Like, think of it just in straight math problem. How many years can I go on? It should be attainable. The goal should be attainable.
But this is not the financial services industry. The financial services industry is about selling you stuff.
No, they don't care. They don't care.
And so they don't care what your goals are. In fact, they want to entice you
Just give
with
me your
a goal.
just
You know, how about this Bitcoin? How about this brand new, beautiful car? I mean, the world is not concerned about your goals.
No, we are.
You know?
I am. I totally am, because it's not about me, right? It's about helping you get to where you want to go.
Yeah.
So make sure they're relevant to you, right? They shouldn't be someone else's goals. They should be relevant to you, and understand the time factor. Understand if you want your goal in 3 years, or you want your goal in 5 years, or you want your goal every 7 years, have some time frame associated with it. The most important thing is this: make it clear and actionable.
In fact, in business plans, this is exactly what they do. It's just that we don't put a business plan for our personal self. In fact, many people who own businesses will do it for their business, but they won't do it for their personal life. You need, by the way, exactly. But you need the help of someone to help you through this. Very few people can do this on their own.
So here are some simple examples of setting goals. Consider all the costs involved in that goal. So the purchase of a car, used car, obviously, very used car. The cost of gasoline, that's a joke, right? Cost of insurance, factor it all into your spending, right? So a plane ticket, a hotel, souvenirs, everything you have to do while you're on vacation is important, like dining, right? You have to count everything in a goal. So a spending plan, and we're going to go through all of these one at a time, allows you to track expenses, know where your money goes, know the difference between needs and wants. So if you want something, a lot of times we're shopping on our computer. Think about that. Do I need it? Close your computer, sleep on it, go back the next day if you still remember, right?
Amazon does not want me to do that.
Amazon does not want you to stop. But how much do I need it? And do I need this or do I need this, right? So give yourself the time to do a little bit of evaluating before you spend. And tracking your expenses, we're going to go through this a little bit more, is really important to understand where the money is going. Avoiding debt. Identify opportunities to eliminate wasteful spending and live within your means. Well, live within your means sounds like something my mother used to say, but I didn't really know what it meant. What it means is spend less than you earn, right? Don't spend more than you earn, because then you're accumulating credit card debt. And saving for financial goals, whether they're long-term or short-term, is a really important concept to eliminate debt. And what we're doing is actually saving you money, because if you're not spending 25% interest on your credit cards and you're still getting your goals done, that saves you quite a bit. And less stress. So we'll show you how to calculate your income, account for all kinds of consistent income, include net income after tax, and exclude things that vary or are unpredictable. So exclude bonuses, exclude any other gifts that you might get from family, unless they're like an inheritance, but not like your holiday gifts, and any other income that varies that you can't really count on. And then tracking daily expenses. Track for a series of months so that you get a good amount of data, right? So some expenses, and we're going to go through this, but some expenses are semi-annual, like car insurance, property tax. Home insurance is generally once a year. So if you track for 3 months, you may not get all of that in there, but you want to make sure you account for it in your analysis on a monthly basis.
By the way, this becomes pretty easy when you're 50, 60, maybe even 70. But once you reach in your 80s and 90s, just becomes a little bit more difficult, and you need assistance. A lot of times you worry and you stress out because of all the medical expenses and your household expenses. How many homes do I see with deferred maintenance, huge deferred maintenance, just because they're afraid and fearful about spending money? And so I think start considering in your 80s and 90s, if you're not doing this, get the help of a fee-only advisor or a bookkeeper or someone to assist you in this part of your plan.
I strongly advise that. I meet with people that can't do it on their own anymore. And sometimes I figure out maybe a bookkeeper is the best idea for you. Someone that comes into your home and helps you. Yeah.
My mother couldn't do this. She'd probably it's probably a loss of interest as well. At about 82, 83. So, we stepped in and assisted her with a CPA, and so that she understood that we're being objective. Because that's one of the problems too. If you're depending on your family, you want to make sure that the family members are not controlling you. The name of the program is It's Your Money.
Your money.
It's not theirs.
All yours. Okay. So here's a couple other steps. I'm tracking your monthly bills. Pay attention to any big changes in your monthly bills. Sometimes miraculously our cable bill goes up. So we need to watch those kinds of things. And then make sure you budget for annual expenses, like I mentioned a minute ago, and add these on a monthly basis, a 12th, so that you're accounting for it monthly, because we need to be prepared to pay those annual bills. So car registration, home and auto insurance, property tax, deductibles, holiday gifts, vacations. We need to account for those things so that we build up savings so that those funds are available when those bills come.
Yeah. And it's not easy. Just figuring out Medicare alone on medical bills is difficult. So
It's true.
Insurance, yeah, it is. It's not easy. I mean, you really have to spend some time on it, but it's important.
Okay. So when you're documenting this, this is what Pete's workbook looks like. Every line for income, have an amount, and then make sure it's either a monthly amount, or if it's an annual amount, switch it to monthly. And this is in your workbook. Start with income. Income's fun to look at. Start with income.
By the way, Laurie, just want to clarify, Dawn is the main writer of this workbook.
Dawn,
Okay.
as Dawn documented. Dawn, I'm sorry, as Dawn documented.
It's the Lord, Noah.
And also in Dawn's workbook.
There we go.
Now we can focus on expenses. So where do you spend from? This is very important. A lot of people say to me, what are you talking about? How do I know what I spend? And I say to them, where do you spend from? And they go, what? Well, you spend from a checking account. You spend on credit cards. Sometimes people even spend from a savings account. So where does your money come from when you go to spend it, right? You're either borrowing it on a credit card, or you're spending it from a debit card, or writing a check. So we have to figure out all those spending accounts and account for every one of them, because sometimes people forget that they spend from 5 places. Seriously, sometimes there's 2 checking accounts and 3 credit cards. It gets complicated when you're spending from 5 places, because you can't leave any one of them out.
Yeah. And as you get older, you want to keep things simple. There's, to get that extra 0.5% of interest, it's not worth it, because if you have too many accounts, you get confused and you can't keep track of it. And when you can't keep track of things, you lose control. If you lose control, you're unhappy. You live a shorter lifespan. You want to stay in control of your money. And this is the way to do it.
Right. So I'm working with a client right now that's retiring in a week. They contacted me 2 weeks ago. So that's my 3 weeks from retirement conversation. They spend from 5 accounts, and they're spending equivalent to the take-home pay. And now they're retiring. And when I showed the wife the spending from 5 accounts, she did this. She didn't understand that spending was happening in 5 places, and that when you add them all up, it's not affordable anymore.
It's the awareness that's important. If you decide, once you are aware that this is the amount you're spending and that's the way you want to continue, that's your choice. Laurie is not
if you can afford to.
Yeah, if you can afford to. But, so it's just being aware is the most important thing.
And this you can do for yourself. This, you don't need a professional to figure out where you spend from. You just have to think about, where do I spend from? If you want to make sure you're thorough, it's good to use a professional, but you can start doing this yourself for sure. You probably know where you spend from.
By the way, when you take a client under assets under management, let's say I have $500,000 I want to invest with you. Is that part of the fee, is putting together this kind of a plan to go through my spending, to put a net worth statement together, et cetera? Or is that an extra fee?
No, in my planning fees, I do all of this work, and I even come up with an asset allocation strategy that minimizes risk for you, but still gets your goals accomplished. I don't go with more risk than you need, just the amount, the basic amount of risk you need to meet your needs. So yes, I come up with an asset allocation strategy during planning.
So when you say, when you come, what you need, so to meet their spending plan and their goals.
Yes.
Okay.
Right. So, back to your spending, tracking your spending is, you can do it in a number of different ways. This is the how do I do it question. So back in the day, we cashed our check and created envelopes, right? We had envelopes for gasoline, we had envelopes for rent. We used a cash-based system with envelopes. A little dated now, but it still works. It's still the same idea. So you can do it on pencil and paper and track your expenses with a spreadsheet, also pretty manual. You can download data from your bank. So you could download spending summaries from your bank, and spending summaries from your bank categorize the spending.
I remember having blue chips and green chip stamps in the envelopes. But the envelope.
Oh, Pete, we're grown-ups. What can I say? Me too. So the other thing that's very cool is you can use a spending tracker, and I'll give you a couple of ideas of spending trackers in the next slide, where you connect your banking data to the spending tracker and it aggregates the data and categorizes. It's pretty high tech. So you have to have a little bit of savvy, but they have mobile-based programs that you can use it in an app on your phone. And some of them even alert you when you've met that spending goal for the month. And a lot of times I use it for people who spend too much on dining out. For example, like it'll tell them when they're 50% of the way through that month's allocation for dining out, it will let them know. So it's a pretty high tech way, but all of these ways that I've listed are viable. So here are some names of apps that you can use as spending trackers. YNAB is you need a budget. That's what it stands for. So all of these come at very low or no cost, and they can aggregate your banking data. But this is high tech. The other things are a little bit lower tech.
So have your 7-year-old teach you how to use this.
At least 7, maybe 12. Yes. Okay. So comparing income and expenses, develop an understanding. This is where I help clients develop an understanding of what's going on. So one scenario, my favorite scenario, is when income is greater than expenses. Knowing how much money remains each month can guide your savings for other opportunities. And then we establish some discipline called pay yourself first. So when you have more income than expenses, you can save. And when you save first, as soon as you get paid or as soon as your income comes in, then you're definitely saving rather than just saving what's left over at the end of the month. So paying yourself first means save first and spend what's left. But that takes a little bit of structure. Like we have to figure out what it costs to be you. We have to figure out your income, and then we have to figure out what can be saved. Scenario 2 is income is lower than expenses. So that means expenses are a little too high and we have to evaluate spending. So oftentimes what I do is help people evaluate spending so that we can get spending lowered so that they can meet their goals. Right? I have a famous story of a woman in her mid-40s trying to buy a house. She was getting $100,000 of assistance from her parents, but she still couldn't handle the house payment on her cash flows. So even if you're getting a massive gift from your parents, you still have to be able to pay the mortgage and the property tax and the HOA. So we created a budget for her based on home ownership.
You know, one of the things that people, I think, kind of confuses is that budget is only for people who have low or middle income. And I'm reminded of the story of the financial advisor who told me that they had to just talk one of their clients out of buying a jet. You know, so it happens at all levels.
Every level, it doesn't matter. Everybody needs to understand income and expenses Even if you've never done it before because you never thought about it, never thought there was a need, there's a need. Evaluate spending with a focus on goals. So this woman, I had to get her to practice home ownership budget-wise to show that she could spend $1,000 more on the mortgage, including property tax and insurance, than she's spending on rent. So we switched up her spending and to practice before she owned the home. So it's pretty important to be ready for a big project like that. It's important to be ready for home ownership so that you don't go into it and then have to give it up, like give it back to the bank. We don't want that to happen. We want our clients to be successful. So ask yourself, do I need it? What's it worth to me when you're spending? Do I need it? Sometimes a home, you do feel like you need it. Can you possibly get ready for it? How many hours of work do I have to do to get it, right? So if you want a $1,200 purse, if you want a $80,000 car, how much work is it? It's an interesting question to think about that. Like, do I really think about it? Like, how long does it take me to earn that much money?
Reminds me of, I have a 35-year-old son, and he recently asked me for some money. And so instead of saying yes or no, I recommended that he meet with a fee-only fiduciary advisor and put a plan together, and then to come back to me and ask for money. And I told him, I said, you know, I will even pay the financial advisor because I don't think you'll listen to me, but you might listen to the financial advisor. So money and parents and children, it's a very complicated situation. And I love my son, and I think he's a very mature, but this exercise is so important.
What session will you tell us how that went?
Before we go on, let me make one point and then ask a question. And Pete's son, incidentally, moved to Ireland. Maybe not coincidentally at the time. And I apologize if there's a scenario 3 on the next page, but I'm retired and I'm drawing down my assets. Is that viewed in your scenario as income? I mean,
everybody generally has some sort of an income. If you have Social Security income, or you have income from required minimum distributions in a retirement plan, or you're taking money out of your account, right? That's a stream of income. It's coming in, and we still
just wanted to make sure we didn't ignore that side of it, because that is income from a cash flow standpoint, certainly.
Yes,
Don, what a lot of people have doing, because they're so used to having a paycheck, they set up their income from their 401k and from their mutual investments, similar to their payroll. So they continue getting a monthly income, but it is income.
Right. Okay, good. No, I agree.
So understanding the relationship between the money you have coming in and the money you're spending is super important. Staying disciplined. What can you get that's less expensive or use less of it?
Laurie, do you go through a person's homeowner's insurance, their car insurance,
Yes.
as to, you know, whether or not they can get it for a less expensive?
Yes, I provide alternative quotes with an insurance professional just to make sure deductibles are reasonable, your premiums are reasonable, and your coverages are adequate for your assets. So it all depends on your assets, because you want to make sure your coverages are adequate to protect your assets. That's the point of insurance in the first place.
And life insurance the same way?
Well, sometimes there's a need, sometimes there's no need. It just depends on who's dependent on you. Okay. But yes, we look at all sorts of insurance. We look at all aspects of spending, because insurance can be quite expensive, especially if insurance professionals have gotten to you before I did.
Yeah. So it really is. What can you get for cheaper? What can you renegotiate?
What can you do without?
What can you do without?
Right. And I have a client who lives with her mother and her sister, and all 3 of them pay for Amazon Prime. So do you need 3 Amazon Primes in one household? Like really? Or all three pay for cable. Like, interesting that if you live in the same house, there should be some benefits to that.
Yeah.
So it's important to think these things through, but people don't always think these things through.
But talking about it to another person is really helpful because, oh, this is what I'm doing.
Yeah,
Self-awareness sometimes takes a little bit of time.
I've had clients use spending trackers and show me that they're paying their HOA dues twice. That they're actually having it auto deducted and writing a check and forgot that they do that. So you learn stuff from spending trackers. You go, oh my God, that's happening. Like, you don't see it necessarily, but you figure it out. So these are other strategies I've listed here. Shop from a grocery list, obviously. That's a good one. As I tell my mother-in-law, which is completely ineffective, avoid Costco. Costco's just too much fun. Like, avoid Costco. She won't listen. But
I have the same problem. I love Costco.
Disable one-click purchasing that makes it just too fast without much thought. Sleep on it, as I mentioned before, and establish money rules, especially whether you're on your own or as part of a relationship. What can I spend without really giving it thought? And what must I really think about? So there's certain amounts you could come up with as a money rule in your house. But if you're going to spend, let's say, more than $300, just come up with some amount in your household that makes sense. That we need to discuss it first. Like, it should be a discussion. We should make sure it works for us, especially regardless of whether it's just you or you and someone else in your household. Oops, I think that's my last slide. Stay disciplined. Sorry about that.
So part of it also is looking at the tax issues, right? As far as spending is concerned. So you're looking at taxes, you're looking at the insurance as part of this. So
yeah, look at every aspect.
This first part, financial planning 1, I know most people think it's pretty boring, but you don't have to, I want to congratulate you, Laurie. You didn't once use the word budget.
Spending plan.
Because people don't like the word budget, but it's awareness is the key. And you can't make that investment decision until you know exactly what you need to spend or want to spend. And it's just not about getting the highest rate of return.
No, spending has much more of an impact on a plan.
So do we have any questions, Don?
I was going to say, Laurie, if that was your last slide, you can go ahead and stop sharing. You can just be us as we come up here. Laurie's done a wonderful job because we have very few questions. So I have questions. Way back at the beginning, when you were doing what are your assets, you had a charitable asset. What's a charitable asset? As opposed to a charity. Do you want me to answer it since I'm the one that put it on the list?
Yes, you can. It's not as common as we might think, but yes, you can explain that a charitable asset can allocate money to a charity and provide you income during your lifetime.
Right. So on the It's Your Estate series, we spend one session on charitable giving. And if you did a charitable gift annuity, or if you had a charitable remainder trust, or you had some other kind, they will provide income potentially for the rest of your life, certainly in case of a charitable gift annuity. And that is an asset to you. And it's important to know that. And from an income standpoint, from an asset standpoint, it's part of what you're worth because you put money into that. Now, we're very quick to point out whenever Pete says, don't buy an annuity, I always say, wait a minute, charitable gift annuity is different than that. But it's a matter of looking at it and saying, what do you want to have? So it's a confusing one because most people don't think charitable, I gave it away. I don't get anything. Yeah, many times you do. And that's one of the things that's important.
Yeah. We also tend to divide things into good and bad. And so just on the annuity idea, and we're going to be discussing that in the investment world, but in some circumstances, an annuity is really worthwhile. Just like what Laurie said about reverse mortgages. Once in a while, this is, if you need it as a last resort, it's a lifesaver. It's just, you can't look at this as a good, bad. you have to run the analysis because never everything has positives. There's always a negative side on it, and you need to weigh those. And that's what makes it hard to make a decision. And that's what's helpful when you could speak to a professional to bounce things off of and says, hey, I really just have your interest at heart to see what is best for you. It's difficult.
And Laurie, when you talk about property tax, given certainly my age and absolutely Pete's age, since he is so much older than me by a few months, we don't have to pay our property tax, do we?
Yes.
No, and no. You can defer your property tax after what, age 65?
You used to be able to.
Did that go away?
I thought it did, but I'm not 100% sure.
Because it used to be you deferred and you paid like, I forget what the interest rate was, but it became a debt against the house, which had been paid at the time that it was sold. But I'm surprised if it went away.
Yeah, it went away after Prop 13, and they were starting to, the government needed the money. And
Okay,
so
well, we'll check it out. We'll check it out.
We should check on that for next week, and we'll have an answer for people.
Right. Yeah, absolutely.
Because that's a great way to save some monies until you retire. I mean, until you're dead.
Well, one of the things that it came up certainly here in Laguna Beach, because there were property rich, cash poor people who were selling their furniture to try to pay their property tax. And that's when it had come in years ago. And I'm touch surprised it might have gone away, but it could have, because yes, they wanted the money.
It looks like it's a benefit to low income seniors.
Okay.
Yeah.
Okay.
In California. So it runs by state.
Yeah, no, I was only California, the only one that I knew of, but
An annual income of 45,800 or less.
Oh, okay. Okay. Yeah.
Good to know.
Yeah. So that's the other thing too, is that you need to compare your income with the rest of the country, because you want to know where you are. Everybody believes that they're at a lower level actually than they are in the community. So if you're living here in Laguna Beach and you have $1 million estate, you might feel very poor, but nationally you're not.
Well, and part of that's about it may also be tied, it may be in your net worth because it's tied up in your house, and which you probably bought at 60,000 however many years ago. Let me stay with budgeting for a minute, Laurie. One of the things that I've noticed with people is auto pay, and you touched on it in the homeowners association. I forgot to budget that because I didn't write a check for it. Yes, but when you download your bank information or something else, it's coming out of your checking account, and auto pays can really come and get you. Especially, as you said, cable bills may fluctuate, but if you have it on an auto pay, you don't know that it's doing that. Yeah.
Yeah, those vendors love that.
Yeah. Yeah. You don't feel the pain. So that's why it's sort of, wait a minute, it's there. So
we do have a question on chat, and I know you didn't want to go there, but let's just, I think you have to have maybe 40% equity in your house in addition to low income, in order to qualify for a postponement of your property tax.
Because it is a debt against the property payable when you either sell it or die, was the way it used to be. So you certainly would have to have some form of equity in there. But anyway.
All right. Not having any more questions. Don, do you have any questions of Laurie? Oh, there's a Q&A that's popped up.
Go ahead, Pete.
It says, be aware of how to pay for elderly folks. Had a friend who had funds taken out for almost 6 months after death. It's a huge problem, especially as a private fiduciary in coming into somebody's estate. And I usually take everything off of auto pay, because that's exactly what happens, from newspapers to cable TV to many other items that are on auto pay. So they're wonderful if you stay on top of them. They can eat you up, and if you don't. And again, you're not going to pay as much attention to stuff once you're in your mid 80s until you're in your 90s. it becomes less important.
One of the things I've seen that's helpful when you're in your mid 80s is to add somebody that you trust, like a beneficiary or somebody else, to your joint checking, so they have access to your checking account and can watch what's happening. Obviously, you don't want someone you don't trust that's going to spend your money, but at least they have access so they can see if nefarious things are going on.
And you have to look at your own family objectively. Okay. Financial abuse is the #1 rising crime here in Orange County. And it's not committed by the caregiver or by the attorney or by the other. It happens within the family. So be careful. And mothers, sons, and daughters seems to have a little bit more complications than the other mix, right, Don?
Yes, there's an entertaining mix in a lot of situations. And Laurie, I just want to make sure that's clear to everyone. When you do a financial plan, you're then going to go through after all these pieces and talk about here's the assets, here's the recommended allocation, other things. Because of the way we separated out the two sections, you didn't get to talk about the fact that, yes, you do that. It isn't you stop after we don't use the word budget
At the
anymore.
very beginning. This is
right.
financial planning 1.
Yes, correct.
And the wonderful thing about doing this on a consistent basis is that you see a pattern. You know, it's not just a 1 year off thing, but if you're with a fee-only advisor for a number of years, they begin to understand you and see your spending, and there's a better relationship because you still have to go through this on an annual basis, at least knowing what you spent that year. Is that correct? Yeah.
And we know what you haven't done.
Yeah. And
you know that 2 years ago, you didn't like the beneficiaries in your trust and you still haven't done anything. Yeah. Like we know stuff.
My sister was married for 40 years, and on their 15th wedding anniversary, her husband asked, "What would you like as an anniversary present?" And she said, "For you to remove your ex-wife from the title of the house." And he said, "But in the divorce, the house is mine." She said, "Yeah, you never told the county." Now the good news was they were all good friends, so there was no fight on it. But it was a matter of, we went, "Oh," and there's oops, I forgot to do that. So anyway.
Tell me a little bit, Laurie, while we have a little bit of time. We're going through a very serious situation with Ukraine, with interest rates rising. Do you find that your clients are panicking? Are they calm? What is your general kind of advice for people?
My general advice for people is that you're allocated according to your risk tolerance. And so there will be volatility along the way. And we're seeing quite a lot of volatility this year. However, there are strategies we can employ when you're not fully invested already. So like if you're thinking about investing, now's a better time to be a bond buyer, right, than it was while interest rates were going down. Right? If we own bond funds, interest rates going up was a crisis for our bond funds, right? When interest rates are going up, our prices are falling. But now if we buy in, I can buy US treasuries earning 2 3/4, 5-year treasuries. Like having some interest rate escalation helps in certain situations because we can now get some interest on the money we have invested, right? And I'm using dollar cost averaging on stock portfolios because there's so much volatility, which means I'm buying over a period of 3 to 6 months. And I'm buying on either a monthly basis or I'm buying at dips. So I'm buying things kind of on sale for people so that I don't know, like I can't predict the future. I don't have a crystal ball, but I do know that volatility is priced in already to everyone's plan. Like I've got 2 years of negative returns, not months, but 2 years of negative returns already in their plan. So they can withstand the volatility and they know that. Okay. But yeah, new investors, I'm having them going slow.
Yeah. And by the way, that's what financial planning 2 is going to be about at the end, is to how to put all this together and put your asset allocation together so that you can withstand up to 2 years of a recession. All right, Laurie, thank you so much.
A pleasure to be with all of you. Thank you for listening.
Yes, thank you very much. So this is Financial State Literacy. This has been It's Your Money, Week 2, Financial Planning 1. There's certainly a lot more in Financial Planning 2 when we come to that one after investments and other kinds of things. And I thank Laurie and Pete and the group as we've been here. And we have a question. Relative apps to check. Privacy is an interesting issue on the spending apps was the question. And that is definitely one that one has to be cautious of. But that's true on every single thing we do in terms of your phone, your computer, anything else you do, being very careful with it. Anyway, thank you all very much. Laurie, thank you very much. Pete, thank you. And we will see you next week when we talk about medical planning. Have a good week. See you later. Bye-bye.
Bye-bye.